Welcome back to Alpha Recap. Mike here, and today we're breaking down a choppy Friday session that closed with a really split message across the tape. As always, if you have questions, you can reach us at stockalpha.ai. Matt, great to have you with me.
Thanks for having me. Lots to unpack from Friday. Some dramatic microcap fireworks, and then a couple of heavy volume sell-offs in bigger names and ETFs that actually mattered for risk managers.
Okay, hit me with the headline movers first. What jumped and what got hit?
So what really stands out here is a microcap that spiked about 75% to $3.73 on roughly 39 million shares. That's not your usual thin market pop. That was real volume. At the same time, we saw a few other tiny low-float names jump in the 60 to 57% range, but on only a few thousand shares. And then another low-priced name rallied about 47% to 3 cents on roughly 350,000 shares. Big percent moves, but very different liquidity profiles.
Wait, really? 39 million shares on a microcap? That's substantial. And then these others on only a couple thousand? That's a huge contrast.
Exactly. When you step back and look at this, the percent move alone doesn't tell the story. One of those spikes was backed by real institutional scale volume, and the others were classic low liquidity volatility, fast gains, but fragile.
And on the downside?
On the flip side, two very liquid names had outsized declines with enormous share counts. One stock fell down about 12% to roughly $10 on about 110 million shares, and an inverse-style ETF dropped about 15% to around $2.02 on about 188 million shares. Heavy selling in liquid products, that has real knock-on effects for options, margining, and funds that hold leveraged or inverse exposure.
So, not great if you were long those leveraged positions.
Right. And the other thing is, forced rebalances can amplify moves. When an inverse or leveraged ETF moves that much in one day, it changes effective exposure and often forces managers to adjust, which creates additional flows into the close.
Let's pivot to the corporate signals you mentioned. Any pockets of conviction Friday?
Yes, Guggenheim increased Sysco's price target to $95 from $91 and reiterated a buy, even though their earnings per share estimates for 2026 and 2027 were unchanged. Also, a firm disclosed a newly reported $10 million institutional stake in Frontdoor, which reported about 14% revenue growth. That looks like real conviction tied to accelerating top-line momentum. And on the software side, two incumbents reported earnings that investors read as a partial rebuttal to the most aggressive fears around generative AI destroying recurring revenue.
Interesting. So, some selective confidence in places, while other areas were getting hit hard.
Yeah, that tracks. Those analyst and institutional moves are the kind of durable signals long-term investors pay attention to when sentiment is choppy.
All right, Matt, before we go deeper, give us the big narrative takeaways from the day in plain language.
Sure. First, liquidity drove a bifurcated market. Low-float, sub-$5 names produced wild percent moves on tiny share counts, while big trades in liquid names and ETFs produced meaningful market impact. Second, there were pockets of selective institutional and analyst confidence. Sysco and Frontdoor are examples that argue some active fundamental buyers were still allocating. Third, company-level earnings showed that execution can blunt thematic fears. The software names that reported made investors rethink how fast AI will disrupt incumbent revenue. Finally, there was a tension between traders hunting short-term alpha in microcaps and risk managers worrying about the fallout from heavy selling in liquid instruments.
Makes sense. Let's dig into the debates people will be watching. What were the main disagreements among analysts and portfolio managers?
There are 4 debates to watch. 1. Whether Sysco's price target bump was justified given unchanged earnings estimates. Is it multiple expansion or a cosmetic change? 2. How quickly AI will structurally impair software revenue. Friday's results suggest disruption might be slower than the most bearish narratives. 3. Whether microcap momentum moves are tradable breakouts or fragile spikes. The huge volume microcap differs from the tiny volume pop, and that distinction matters. 4. Interpretation of the ETF flows. Was that massive decline a hedge unwind, forced liquidation, or a signal of durable outflows in the underlying asset class?
Honestly, I was a bit surprised by this one.
Me too. Market moves like that tend to create loud debates because the data is so mixed.
Quick reality check on the microcap pop that had 39 million shares. What should people do if they spot that kind of move?
First, look for a catalyst. News releases, institutional filings, or sizable option flows. If you don't find any, be cautious. Even big volume spikes can fade. For the tiny volume names, assume extreme volatility. Size your bets for a total loss, use exit rules, and be mindful of spreads and slippage.
Short reactions. Short and sweet. Is Friday a sign of a broader risk-on rally or just noise?
Selective risk on, not broad-based.
Buyable weakness in defensive names?
Potentially, especially where an analyst or institution just showed conviction.
And for ETF holders?
Reassess margin and rebalance thresholds. Many holders of leveraged or inverse ETFs felt meaningful pain on that one-day move.
Great. Walk me through how different investor types might have reacted or should react to Friday's action.
Short-term momentum traders found setups in microcaps and software relief rallies, but they faced big risks, wide spreads, and execution slippage. Income-oriented investors could see Sysco's higher price target and reaffirmed buy as validation for a dividend growth tilt, though the upside could be multiple-driven rather than earnings-driven. Long-term growth investors should pay attention to Frontdoor's 15%-ish revenue growth and the institutional stake. That's a signal worth a deeper fundamental look. And risk managers or passive ETF holders needed to check margin rules and tracking error after the big ETF move.
Right, so lots of nuance depending on time horizon and liquidity tolerance.
Exactly. One investor's opportunity is another's landmine if they don't size properly or understand liquidity.
Okay, Matt, practical checklist heading into Monday. What should traders and investors watch first?
Number 1, monitor volume and liquidity on the reopen. See if the big microcap keeps trading big or if it fades. 2. Distinguish volume-backed moves from low-float spikes. Use absolute volume thresholds as a filter. 3. Recheck fundamentals before adding size on names with analyst signals. Confirm local case trends for restaurant distribution plays and unit economics for service businesses. 4. Manage options and margin risk for ETFs. Be ready for rebalances or margin calls after big one-day moves. 5. Use strict position sizing and stop rules in microcaps. And 6. Listen to upcoming earnings call commentary for more color on AI and disruption timelines.
Solid list. Any final quick takeaways before we go?
Yeah, think liquidity first. When you see large percentage moves, ask, is this backed by major volume or by a couple thousand shares? Lean into selective, durable signals where institutional money or analyst conviction exists, and tighten sizing in the noisy parts of the market. And keep an eye on filings and Monday's volume patterns. They'll tell you whether Friday was noise or the start of a trend.
Key takeaways for listeners. 1. Liquidity drove a bifurcated market. Big percent moves were not all equal. 2. Selective institutional and analyst conviction matters right now. 3. Manage ETF margin and rebalance risk after heavy one-day moves. And 4. In microcaps, size for a total loss and have an exit plan.
Yeah, absolutely. Those are the priorities.
All right, that wraps it up for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. Catch you next time.